All right, good morning. Comment allez-vous? How are you? Don't slouch when you trade. I'm back and I got a bigger gat. Alrighty. Let's get on with it. All right, so welcome to Forex.Today, the YouTube community of almost 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of putting together trade plans. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne McDonald. I'm a currency trader just like you. I love technical and fundamental analysis. I'd like to put together trade plans in advance. I don't like to respond to markets, or I should say react to markets. There's a logical reason for why everything's happening. I always look at the world from a Newtonian physics point of view, which means it's like clockworks. Okay? So the thing is, you got to pull the clock apart and figure out how it works. So sometimes that's complicated. We have somewhat unusual market conditions. This is not a typical situation. Typically, you don't have a problem with supply. That's the biggest thing or the most challenging question mark of what's going on right now. The lack of supply is then changing all kinds of things. It changes prices, and then prices impact demand, and you have this up and down, and the Federal Reserve and other central banks are doing what they can, but all that does is impact the demand side of the supply-demand equation. So we're monkeying around with demand, but our problem is mostly supply. And not every country is impacted the same or equally. And so that's really interesting. So this is an unusual year. Unusual market forces impact the value of these currencies, or maybe not the value, but maybe the direction of the flow of money. Typically, the flow of money is dictated by business transactions. I wouldn't necessarily say greed and fear. We're animal spirits. I mean, that's part of it. But usually it's just business. And so business is a challenge because we're in this situation where there might be buyers, but if there's no sellers, it's kind of like the tree that falls in the forest. It doesn't make a sound if nobody hears it. Well, are there really buyers if there's no sellers? What are the buyers? So anyway, so thank you for being here. We'll try to figure all this out together. No need to do this alone. Cool. So ask questions, get involved, and I will see if I can help. Thought today we'd go through the calendar and just check on big things. We know we got big news later today. We know we got big news later this week. So I thought we'd just jump into there. And I think today will be nice and short and sweet. We'll go through we'll look at the indices. We'll look at gold, oil, and Bitcoin, yen pairs, dollar pairs, and that should be enough, I think, for today. Tomorrow we'll probably lose volume and volatility, and then Friday, as you probably know, is non-farm payroll. So anyways, we'll take a look at all that. But if you ask questions, you get to dictate the direction of each and every one of these live streams that I've been doing for nearly 20 years, which is amazing because I'm only 35. So holy smokes, right? So anyways, ask questions, get involved, take notes, write things down, leave comments on the recordings. Please click the thumbs up button. And then in the description below the recording, you'll see there's a link to my book. You might find that helpful if you like reading books. If you prefer watching videos, there's free videos in the description below the video. There are premium videos that cost a whole $88 for 65 hours. Oh my gosh. Okay. The link to that is in the description below. And of course, a link to tradersway.com, whom I believe to be a trustworthy, ethical foreign exchange trading brokerage firm that actually has very fast execution speed, narrow spreads, huge swaps. So it's kind of like the, how do you say it? The complete package. Like, wow. So anyways, tradersway.com. A link to them is in the description below, or you can just go directly to the website. That's fine. But you're going to need a broker one day, and that's whom I would recommend to you and to me and my mama. All right, so let's take a look at the charts here. We'll move. I guess we can start here. All right, so this is the S&P 500. By the way, you can get there. Just go to tradersway.com, click MT Web. It'll pop up MT4 Web. Then you'll want to switch it over to MT5 Web, and then you get here. And you just switch over by clicking File. You can go from 4 or 5. And on S&P 500 is on 5. So anyways, well, how'd my graduation ceremony go? It was great, actually. So it was strange. I walked across the stage again, and they gave me a big envelope, and again, and I opened it up, and there's like a note that says, I forget what it said. It was like 2 sentences. There was no degree because I already had the degree, but it was really cool, and we had the most beautiful day you can imagine, and that was just great being back in, just back in the old yard and stuff like that, and it was just great. It was great, but thanks. Yeah, I mean, the school is just such a unique place. So it's just great being back on those stomping grounds. The one thing I can share that I was a bit surprised, but it makes sense, from an economic point of view. I go back to Harvard, and you got to remember, things got shut down because of COVID. That's why my actual graduation ceremony, even though I graduated 2 years ago and got my degree 2 years ago, we only just actually did the ceremony, right? So anyway, so we go back, and there are like major institutions, and by institutions, I mean bars and restaurants, all around Cambridge that have been there forever. Okay? They were closed, like permanently closed. Just shut down, went out of business, dead, over. And it was sad. John Harvard's closed, Border Cafe closed. You guys remember that Goodwill Hunting? And he's like, "Hey, do you like apples?" And he slaps her phone number on the window. "How do you like them apples?" "That place is closed." You're like, "You're kidding me." So it was a bit sad. It was a bit sad, but I guess that's what happens when you shut your entire economy down. Yeah. But anyways, we had an epic day and all that kind of stuff, and it was really nice, and it was good to see some of my old friends and all that. So thanks, but good to be back. So let's take a look at the stock market here. Okay, and we're I'm on a 4H now, right? And we were kind of looking at this not so long ago, and this was an important turning point, as we talked about in that moment. And then we had this consolidation. Do you remember what we were talking about back then? Not down is potentially the beginning of perhaps up. Okay? And sure enough, it's been up, which is great. Now, I already had it marked out. And so again, we did this a couple of weeks ago. And so we have a red line on the bottom. I guess I can mark this, make the red line blue. That only makes sense, right? Okay, we already marked that long ago, but then long ago, a couple of weeks ago, I marked this price out as something that should be important in the future. If we don't break it to the upside, that's relevant. But if we do break to the upside, it's also relevant. And so we're looking at this as potentially the next step. Again, not It doesn't have to be that way, but that's what you would look for technically. Okay. One of the things we've talked about a long time ago is I do expect some level of up in the stock market, but not a higher high, not 100% retracement, not, this whole process is over and now it's nothing but up. No, I don't think we're going to get to this top, but I think we can get a ways there and then just kind of fizzle and stall and fart around, all basically to the end of the year. Okay. Now, why is that different than years past? Well, in years past, when the stock market's falling, the Fed is cutting interest rates. And in years past, when the stock market's falling, the Fed does quantitative easing. They buy bonds. Well, starting today, they're selling bonds and letting bonds roll off their balance sheet. And on the way down here, the Fed was raising interest rates, not cutting interest rates. This is a topsy-turvy world. And that's very unusual. And that has to do with kind of the situation where, again, this is not a demand problem. Much of this is a supply problem. And because of that, the Fed put, which just means in the years past, if the stock market was falling like this, that's all right. The Fed comes in and does quantitative easing and pushes it back up. Remember 2008? Remember COVID? That big move? Okay. Okay. That's as far as it'll go back. Okay. This big move, that's because the Fed was able to come in and do quantitative easing. We're not going to get that now. In fact, the opposite is likely to happen, or is happening. The Fed's raising interest rates, and the Fed is doing quantitative tightening, not quantitative easing. So in that case, with that being said, I believe, and I did say this back in November, December period, that, and by the way, I said it would go up in April, and here it is. It didn't go up till the middle of May, so I didn't get it. I'm not trying to sell me. What I'm trying to sell is the logic. Okay. So anyway, so now I believe we could say maybe perhaps the worst is over, and we get somewhat of a recovery, but I don't expect higher highs. Okay. But once we find our sort of current high, then it'll just sort of fizzle back down, and maybe we even double bottom at the end of summer. Oh, all the way back. So maybe this goes to 4,500 and then all the way back to 4,000 or something. Yeah. Okay. So we have to get through this year, which is not easy. Okay. You got to get through this year, and then next year, maybe we can deal with the real problem. The real problem being supply. But can you force China to open up its factories, produce Barbie dream house, and get it to Walmart in time for Christmas? Can you force that? No. Are they naturally incentivized to do it? Yes. But they might say public health is greater than Barbie dream house. Which, I don't know, might be true, I suppose. Anyway, so so there that's the level or layers of complexity that we have going on here. Okay. Cool. So that's that. Okay. A couple things I want to look at. Canadian GDP. You pop this open and go to historical values. You can see flat, but not terrible. About average. Okay. This is where we were farting around before. Oh, way down here. Whoa, way up here. And right back to where we are. Okay. So not terrible, but obviously this scale throws things off, right? But anyway, so that's back where we are. Looking at Aussie. Same kind of thing, but this is much more disappointing. Or maybe this is just much more overblown. There's like base effects when you go from negative to positive, and then, you know, but you can see there's more volatility compared to Canada. Okay, and this is like COVID recovery, China lockdown, China not locking down, China locking down again, so on and so forth. More complexity versus Canada, because remember, Canada can sells to the United States. Okay, so there's a steady sort of like back to normal. Yeah, like if we got rid of the scale, then this would look very volatile relative to long-term historical norms. So this throws things off. But nonetheless, you can see, you know, it's okay, right? It's okay. But then you go to Australia, much more volatile. Okay, much more volatile. And to me, that has to do with more exposure to a volatile situation, and that being China and that lockdown. Okay. Cool. So, speaking about Kenyatta, interest rate decision coming out today. Okay. Okay, so here's a Banque du Canada. There you go. You're welcome. Okay. Notice they don't have a dual mandate. We work to preserve the value of money, not your job. Sorry, eh? Okay. So anyways, high inflation, low interest rates. So that's likely to change, eh? Oh, for sure. Yeah. Don't you know? Okay, so anyways, yeah, that's about to change today. And you want to try to look at, through maybe statistical research, not just that the Bank of Canada is going to raise interest rates today. Of course they're going to raise interest rates today. So it's more like, how many more times? What's the terminal rate? What's the neutral rate? What's the blah, 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 blah? Okay? Okay, for example, let's look at medium CPI. Okay, look, 1.9, 2.1, 1.7, 1.6, 1.7, 1.8, 1.9, 2.0, 1.9, 1.9, 2.0, 1.9, 1.9, 2.0, 2.1, 2.0, 2.2, 2.1, 2.1, 2.1, 1.9, 1.9. Just goes on and on and on. Okay, 2.5. You're like, wait, 2.1, 2.2. Hey, 2.2 is high. 2.5, 2.5 compared to 1.9, 2.7, 2.9, 3.0, 3.2, 3.4, 3.4044. Holy smokes. We went years and years and years just farting around 2.0, and now we're 4.5. But look at the exponential growth, right? 2.1, 2.1, 2.1, 2.2, 2.2, 2.5, 2.5, 2.7, 2.9, 2, right? 3.0, 3.2, 3.4, 3.6, 4.04. It's just faster and faster, 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 faster. Holy smokes, eh? So anyways, definitely need to raise interest rates. Okay, so if you looked at, maybe what the interest rate was back in 2019, and you say, well, the median inflation level has doubled, could you argue perhaps the interest rate could double just to stay the same? In fact, it's more than doubled. For those that took the macroeconomics course at FX Bootcamp, you know the difference between M1 and M2. Okay. Let's go back to that 2019. We'll just pick one. Okay, we were at 2.1. Interest rates were 1.75. Then not long later, it went from 1.75 to 0.25. What the hell? All right, so like when inflation, let's say, was about 2%, okay, about 2%, interest rates were about 2%. Okay, and now inflation's 4 and change, and interest rates are only 1. So an argument would be the Bank of Canada could raise interest rates to 4%, and it would still be behind proportionately. Okay, but what economists would be looking at is they think inflation is going to come down over the next 18 months, and this is going up. So really what people are saying is, well, maybe in 18 months, this will be back to 3, and therefore, 2.5 would be enough over here. Because inflation should be just a little bit higher than interest rates. You want a little bit of inflation. Okay. So interest rates are going up. Yeah. I'm just looking at this nominal Canadian effective exchange rate. 2017, 115, 115, 113, 114, and then boom, Canadian dollar got really, really, really strong and then cooled off. Cooled off, stabilized, and then boom, got really strong again, huh? Look at that. $1.25, huh? So the exchange rate has jumped quite a bit, 10 cents from those days. Okay. Oh yeah. All right. Let's move on to another topic. So I was looking at Japanese government bonds, in particular the yield on the 10-year Japanese government bond. Currently, it's stuck around 0.25 because that's what the central bank wants, 0.25 or lower. Okay? And you can see what it has been going all the way back to 2017. Okay, it was below. Okay, then it kind of came up, and then, right, yields came down very aggressively. What happened there? People were buying. Prices went up, yield came down. And all of a sudden, that reversed. People were not buying JGBs, they were selling. And then more recently started selling very aggressively. And that's why we stabilized around here is the government, the central bank, wanted to stop all these Japanese government bond sellers. People were getting out of Japan. By people, I mean people's money. But that can only work for so long. And what they'll probably say is 0.25 is something that's not sustainable. And according to this, 0.33 in the future is probably more realistic. Okay? So you're like, well, how does this impact? Okay, how does this impact the USD yen? Is that what you were asking? Yeah, good. That's a good question. Let me see if I can get this just a bit smaller. Okay, so take a look. This is about the same. 2020 is about here. Okay, so you can see fizzle, fizzle, fizzle. Okay, yen is just a bit stronger than US dollar. And then all of a sudden, yen got very strong around, right, until what, fourth quarter of 2020. So, right, so we're talking about this period here. Okay, you can see it was down, 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 down. Quick recovery, up, stabilize. Okay, then up, stabilize, and then up. Very dramatically here. So key takeaways, if this is going up, well, if this is going down, USD yen tends to go down. So if yields are falling, people are buying Japanese government bonds. What are they buying them with? Well, if they're foreign money, but then they got to convert it to yen and yen gets strong. And then when it's going up, that means yields are going up, prices are falling, and that means people are selling. That means they convert their Japanese yen holdings of Japanese government bonds, converting it back to foreign currency. And in the interbanking system, there's more yen floating around because everyone got out of their yen, sold their yen, to buy their local currency back. Okay, so this is what we've been watching here. And if suddenly the Japanese government or central bank decides to get out of the way and allow this to go from 0.25 to 0.3 or 0.33, that will allow for some additional weakness in Japanese yen. Now, the next thing to note is that this was, slow and steady, steady and slow, and then all of a sudden there was this amplified move. Okay? And what this chart shows is amplified and then kind of fizzle out, and it seems like this was relative, like if you drew this to scale, it should have just kind of looked like a big move here, but it's a ginormous move. So at that same time, because we're only looking at Japanese government bond yields, and from that we can derive price and flow of money, but we're looking at this saying, hey, this is over the scale, if you will. This is too steep. It was too much too fast. What would explain that? US dollar strength at the exact same time, Japanese government bond yields indicated weak yen. And what that also describes is that's not a global macroeconomic scenario. Usually, and the reason why this is so similar is that the scale is smaller in the normal periods because, not always, but generally, when dollar is strong, yen is strong. And not always, but generally, when dollar is weak, yen is weak. Or when yen is weak, dollar is weak. Like, there isn't one leading. A macroeconomist right? Or a macro trader would say there's a global challenge in the global economy, and global economic growth is slowing, and therefore dollar and yen would get likely to get strong. Maybe not to the exact same degree, and that's why you still get ups and downs. But generally speaking, global macroeconomic growth is slowing. Both dollar and yen will get strong. Well, like in this situation, wow, dollar was ripper strong and yen was ripper weak. And you're like, wait, whoa, what? And that's part of the unique challenges that we're facing this year. Will it be the similar next year? Not to the same degree. I think we'll move closer and closer to macro trends. But I'm really thinking 2 or 3 years out from now, because I don't want to sit here hoping the macro game stabilizes. Like, no. What do we know? What do we know? What we know is the supply chain is still going to be screwed up next year. And that your little princess might not get a Barbie dream house this Christmas. I know. Huh? And cats are going to live with dogs. Okay? It's going to be crazy, because even if we get our, right, like, no matter what happens with central banks, they're not going to be able to tame the economy. What would that do? High interest rates destroy demand. Okay, but what do we still do? Okay, so now nobody has any money, but you couldn't buy anything anyway. So what's the use of money if you can't buy anything? You can't convert it into a Barbie dream house. Then what? Then your money doesn't have any value. So higher interest rates are required because they were unusually low, and arguably much too low to begin with. When I first started trading foreign exchange, I think it was like 5.25 was what we were catching on the dollar. Mortgages were that high too. Mortgages were high. Okay? So holy smoke. So we got a long ways to go to get back to a normal market. We still never got interest rates back to where they should have been since 2008. So we can get there, which is great actually, because while we cool off the economy and somewhat reduce some of the inflation, maybe the supply chain slowly comes back, and in 2024, the Fed realizes they raised interest rates too high. And prices, because of the improvement in the supply chain, not because of the central bank policies, those would just be back to neutral. And that needed to be done anyways. But if they go a little higher than neutral, and that's what they're saying they're going to do. So if neutral's 2.5, they're going to go to 3.5, right? But in 2024, which is 18 months to 24 months from now, they might find, well, interest rates are higher than inflation. And as I just showed you looking at those historical charts, that would be unusual. And guess what? 2024, the Fed reduces the interest rates, and our slowly but surely recovered stock market would then have that big boom again. And I don't know. What do you do in 2025? Yeah. It's going to be party time. Huh? Buy those champagne futures now? Was that too far? Am I thinking too far ahead? Thinking too far ahead, huh? Okay. Let's take a look at where we are. Oh, I didn't do one other thing. Hang on now. I guess we're still here. Well, that's not what I want to do, but let's... Oh, I thought I had it. Hang on. Nope, maybe here. Yeah, I guess I have it here. All right, so what else? So Bank of Canada coming out today, non-farm payrolls on Friday. Okay. I said manufacturing, but I'm more interested in services. So anyways, Bank of Canada today, and then Friday, non-farm payrolls. Don't forget that. Okay. Now taking a look. Okay. So we hit this this logical target. I find that's perfectly fine. That says stop selling. And by and large, I did. But now we're stuck in this area. Remember, before you get here, it's still technically bearish. Now, you can be bullish, but I'll say, okay, you're bullish. And we could have a discussion why. But technically, it's not bullish yet until you breach this. So it's kind of tricky, both for bulls and bears. Like bears should be selling here, bulls should be buying there, bears should be selling here, bulls should be buying there. And you get this sideways action. So for almost 2 weeks, nothing really happened here. You could have done well, you could have done not well, you could have done okay. But all of a sudden, just more recently, there's the technical breach. Okay? So, look, even if you were predicting that as a bull and you were buying dips, well, congratulations. But even then, it's one of these things where I got you. I understand what you were doing. But technically speaking, it's still a bullshit opinion. Pardon my French. And so you still have to put it together technically, manage the risk, because you don't know. And a lot of this had to do, of course, with the stock market rebounding. And that's why during this whole period, we were watching the S&P 500. Okay? And so, again, if you want to watch it in real time, I recommend you go to tradersway.com and utilize the tool they offer you. Right? Again, let me just show you how do you do that. Okay? Tradersway.com. Okay, now there's a demo account for MT4 Web. You want to switch it to MT5. MT5, S&P 500. If it doesn't open up the S&P 500, you just open it up to S&P 500. So anyways, that's how you do it. And so you watch it. And this is daily, of course. So what are we looking at here? Hourly. So you'd have to go all the way out. And so what we were watching is this consolidation period. Okay. Remember, I was saying around here, not down is the beginning of maybe up. And you can see test, 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 right? Test down, test, 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 down, test, 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 test. And then what? Higher, high, higher, low, higher, high, higher, low. And right? And eventually it made this. It made a run and made a break higher than this 4,100. And so now it can be a bit tricky because you're going to run into a lot of resistance because it was bearish. So there's going to be a lot of resistance on top of you only because you're recovering. Now, so the best thing to do is pay attention to those key levels, but use the moving averages as dynamic levels as support. Right? So, based on correlation, they should all be doing about the same thing. And what you should probably be most interested in is, do you buy a dip? And if so, what's the price? Okay. Do you buy at a monthly M3? No. Do you buy at a weekly R2? No. Okay? It's not what I teach you anyways. So ask yourself, if not that, then what would you buy? Okay? And do you believe, for example, these bias pivots should be bullish and not bearish? Make sure you update. Okay. Can I look at euro dollar? No. No. Okay. Euro yen, same thing. Are you bullish or bearish? Okay. Again, logical price for a bounce. But remember, this doesn't mean buy. It means for bears to buy. It means for bears to stop selling. That's what the meaning of it is. So don't look at this and say, I should have bought there. No, you should have stopped selling there. But then, we get this big move, support, okay, top, higher low, top, higher low, top, higher low, right? So again, up until the breach, okay, it's not that great of a market. But it's not until after the breach, so you're up here now, that you can say, well, now I can drag this across and use that as a role reversal. But before then, buying a dip for a bull is great, okay? But it's actually not that easy, but it can be done. Double bottom, higher high, higher low, buy. But then this one might have taken you out. You might have found it frustrating in the moment. But the higher high, higher low is a key level, and now we have a new higher high. So typically you might you might do something like this and say maybe in the future you got something here. Okay? Okay, CAD yen, same, whatever. Same. Okay, euro dollar. Okay, this is way out on a daily basis. What do we know from here? That a bear, if they exist, would love to sell at a price about that price. Okay? Now, actually, technically, or let's say price action wise, it would say a little bit higher. But based on market analysis, that's about the price. In fact, it's 107.59, and it basically went to it didn't go to 108. So that's about right. So now if you're a bear, you're going to look at it this way. Hua? Now maybe it's just a little correction and it heads back up, and that would look like that. But nonetheless, a bear is thinking about this right now. What? 107.5, maybe drop it like it's hot. Okay? You got to be careful, like we haven't breached any of these moving averages yet. And also, this is supportive here. So that's the problem. Like I showed on the yen pairs, because the yen pairs have been trending down so strongly, there's going to be a lot of resistance above us. So going up is a bit of a challenge. Okay? And same thing here, because this has been up for a bit. Coming down, there are going to be a lot of challenges. Okay? Now, risk on would dictate US dollar weakness. So if you're thinking stock market up, this probably should be up. And now Europe also, there's a lot to discuss at the ECB. How are they going to manage their bond portfolio? What are they going to do with interest rates? And so there's a lot of questions around that for you to do research on. Aussie's been trending up since this technical out. This is a technical bearish out. Then it made higher high, higher low, buy, 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 and now we have a new higher high, so just get out of the way. Don't worry about it. Your job's, you probably did this yesterday. And at some point you might have this as your plan. You probably want to drag this across. And your plan now is let it come up, let it come down. Maybe you'll buy some Friday or Monday, right? Right? Because this is all what you see now you should have traded a couple of days ago. Okay? Piggy, piggy, piggy. Huh? BOD, right? BOE is the worst days. Anyways. Now what? Potential slowdown technically. Higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, up, no higher high, lower low, lower high. What? So at least it's farting around here. But remember, this line in the sand is important for bears. So what could set up here, I don't know if it will, but a bear is going to try to take that down. A bull, I look at the bulls and say, it's pretty mediocre at the moment. Okay, kitty cat doing well here. Great. Okay, these are hard to catch. I mean, I'm telling you, these are hard to catch. So you got obviousness here, but typically what you don't expect is like this and then breach through and come around. That's just like, it's almost a worst case scenario. It's hard for everybody. Because by the time you get the trend you want to get, you believe in the trend, then the trend breaks and collapses. But ultimately, I do want Canadian dollar strength, and I do want US dollar weakness. You must remind yourself, US dollar weakness is a sign of good. It's good. If the United States is doing aight, then US dollar should be weak, and right? Not randomly, but there is a relationship where if the US is doing good, Canada's doing good, which means this should go down. That's actually what we want. Okay? This whole time here, I said I just don't want to sell the Canadian dollar. Okay? But here's the thing. So now you get down to here. Well, technically, this higher high would set you up to look for a higher low, and it kind of comes back, but not quite to the right price, and then does nothing for an entire week, and then what? When you get onto that clue train, and just because it is coming down doesn't mean you should be selling it. It just means it is coming down, but to what level can you predict it actually doing it reliably without opinion? I think is arguably like if you looked at all of this factual, you'd say, well, even if you want it to come down, the probability of it heading up now is quite high. In particular, after this bullish engulfing candle, it's not like you're like, oh, look, the bullish engulfing candle, sell the hell out of it. Like you just, so if you're on here, I think if you sold it sort of in this period, you're fine. Selling it up here after a higher high, I just don't get. No, I would argue that wasn't great. Like, think of it. What's the logic? Okay, double bottom, higher high, higher low, higher high, sell. I don't know where you would get that logic, right? You just wouldn't do that. If you were cold stone set to be a bear, you would then take maybe risks like this where you have a bearish engulfing candle and then you get the role reversal and you're taking it down this way. If you had to be, you could. But you're also looking at CAD yen, CAD Swissy, but also probably like Aussie CAD, Euro CAD. You're probably looking at Euro CAD. And so you're probably seeing CAD strength across the board. And if so, you probably, until you could really confirm this weakness, you probably still didn't do this trade. So don't confuse with falling as you must be selling. No, remember, you're trying to understand the why so that you could reasonably accurately predict the direction. You need more than just the direction. So whatever you got. So I hope you're killing it. I hope you're making tons of money. And I think that's it. I'm going to leave that. That's that. I hope you have a wonderful day. I missed you while I was gone. So I will see you in the morning. If you're in my day trading group, I will see you this evening for trading Asia. Right? It's only Wednesday, right? And then tomorrow, I will see everybody in the swing trading group to plan out the rest of June. Nice. So let me say it. It's been a few days, huh? Peace on earth. May the pips be with you. May your profits be above average. Thank you for being part of our community. Cheers.